Chances are you've heard of an exchange traded fund, and if you haven't, well, think of these as a collection of various financial securities, be it stocks, bonds, gold, whatever it might be, that are grouped together essentially to make our lives easier as investors, and for good reason. ETFs have quickly become one of the most popular financial instruments available, with their assets under management growing at an exponential pace over the past 2 decades. And why is this, you might ask? Well, an exchange traded fund is going to allow the investor to gain exposure to every single position held within that fund, all with one single holding. And they typically also come with much lower expense ratios, so the costs associated with them, than their grandparent, the mutual funds. Hey everyone, my name's Griffin, and I hope you all had a fantastic week. So there are currently thousands of different ETFs to choose from across North America, meaning it can be somewhat difficult to pinpoint and choose which ones might be appropriate for your portfolio, as well as your overall needs as an investor. With that said, do keep in mind this is by no means a video going over the absolute best ETFs ever. Rather, these are just broad market exchange traded funds that I'm currently looking over and that can be great additions to a portfolio for a long-term investor. In fact, this actually isn't the first time that we speak about ETFs on the channel, of course, and I made a very similar video to this one at the beginning of last year in January, going over 5 ETFs to watch out for in 2021. So hey, I think it would be kind of fun to kick off this video by looking at those 5 exchange traded funds, see how they performed over the year, because even though I do wish I'd had a crystal ball, well, I'm not at that level just yet. So that first fund in last year's video was the Schwab US Small Cap ETF that holds around 1,800 American small cap stocks. And my logic here for a longer term hold with this one is that smaller cap stocks are seeing a relatively nicer valuation than large and mega cap companies in the United States. So this could prove to offer some nice upside over the coming years, which I still think is the case. And well, the SCHA ETF has pretty much trended sideways though over the past 12 months. Again though, I think considering the underlying valuation moving forward, this is still a great long-term hold ETF. The second ETF was the ICLN ETF, which is a global clean energy ETF that holds a variety of different stocks from companies that are involved in all different verticals of clean energy. Now, hey, this ETF is down significantly by around 40% since last year. And you know, look, in the short term, anyone who has invested in clean energy over the past year has definitely taken an L. Of course, they can't all be winners though, especially in the short term, and especially in regards to an industry like clean energy that's going to take at least 5 to 10 years to gain a stronger foothold in the energy sector as a whole. Now, this is the type of risk that you're taking when investing in a more sector-specific exchange traded fund like clean energy. The third exchange traded fund was more of a broad market fund, being the VTV ETF by Vanguard, that invests in positions considered to be in a position of value relative to the rest of the stock market. Now, this ETF is up roughly 20% over the past year, so just trailing behind the returns of the S&P 500, but nonetheless a nice return for such a passive position. And I think that it'll continue to perform quite well in 2022 in parallel to the rest of the market, considering that it holds rock solid companies. ETF number 4 here was the iShares Medical Devices ETF, ticker symbol IHI, which saw some really nice expansion over the first 8 months of the year, and it has since retreated down a bit. Now, longer term though, medical devices is an industry that I'm definitely bullish on. We're just going to see an increasing need for these types of devices. So as a long-term hold, I still think this is a great option for a broad diversification towards this sector. And finally, the fifth and last ETF in last year's video was the BETZ ETF offered by Roundhill Investments, which invests in companies that are involved in either the sports betting and or the iGaming industries, which received a lot of attention over the course of 2021 as many US states legalized sports betting as a whole. That ETF though did perform decently over the first half of the year and has since struggled quite a bit, and I don't necessarily believe that this ETF is going to beat the market over the course of 2022 just based on the overall market environment right now. Alright, so we've recapped the ETFs from last year's video. It's now time to speak about 2022, and we're going to start off with 5 positions focused on capital appreciation, followed with 5 positions focused on cash flow, right? So that dividend income, which I think is also very important to focus on in an environment where we're seeing higher levels of inflation as well as expected higher interest rates over the course of 2022 and beyond. Having said that, let's jump right into the first growth-oriented ETF, and let me first ask you, how awesome does it sound to hold one single position that gives you ultra passive returns, a low management expense ratio, and that Warren Buffett himself says most retail investors should focus on primarily? Well, it turns out you can get that with the VTI ETF, where one single share of this fund is going to allow you to buy and hold a portion of almost every single company in the United States, which happens to be over 4,000 stocks. So when it comes to passive investing, it really doesn't get much better than this, where you can just sit back and watch your investment ride through the overall long-term growth of the American economy. And as Warren Buffett puts it, if you believe that America is going to be in a better place 10, 20, 30 years down the line, a long-term investment into a broad market fund like VTI is sure to come out a winner for you. And over the past 20 years since inception of the VTI fund in 2001, it has averaged returns annually of around 9.04%, with much higher returns in more recent years. Oh, and by the way, just quickly here, it's very possible that we will not be seeing the American stock market expand in 2022 and 2023 at the same pace that we've been seeing over the past couple of years, which is above 20% annually. That is basically just unsustainable over the long term. But even if we see returns closer to that average at around 9% over the long term, this is going to greatly contribute to the long-term exponential growth of your portfolio. And that's exactly why, regardless of where the market is, I like to dollar cost average into these types of broad market index funds if you do have a long enough time horizon ahead of you. And at ETF number 2 here, we have VT. Yeah, we just ticked off the I from the VTI ticker symbol, but this ETF is going to add thousands of individual companies to the fund. In fact, this is the total world stock index that has over 9,000 individual companies spread out across the world. And at a slightly higher management expense ratio than the VTI fund, one single share of VT will provide investors with exposure to companies in established countries, but then also emerging countries like China, Russia, as well as India, all of which are expected to see much higher levels of economic growth over the next decade than North America. Do keep in mind though that economic growth doesn't inherently translate over into equity growth, which I know can seem kind of confusing, but think of it this way. The stock market attributes a value to every single company, and typically speaking, the market doesn't attribute as high of a valuation to international stocks as North American stocks for every single dollar of net income. Nonetheless, the VT ETF still provides investors with exposure to international stocks in countries that are experiencing booms right now, while maintaining a healthy portion of North American positions. And just because of how diversified this ETF is, the VT ETF has average returns since inception in 2008 at around 8.4%, which is below that of the S&P 500 as well as just the overall American market, but nonetheless is still a very nice return for such a passive fund. Growth ETF number 3 is one of my personal favorites and is also very popular among passive growth investors, being QQQ, offered by Invesco, that holds shares of the top 100 companies that trade on the NASDAQ exchange. And just by the nature of the NASDAQ, this is going to be heavily weighted towards the technology sector. Yeah, in fact, the NASDAQ 100 is weighted at roughly 48% towards tech stocks, meaning market fluctuations are going to be heavily influenced by companies like Apple, Microsoft, Tesla now, as well as Meta Platforms, which has been extremely lucrative for investors over the past decade. So right now we are seeing sector dominance in tech, which for the record may or may not be the case 10, 20 years down the line. But considering how things are trending, this is probably going to only be increasingly the case, as technology is a sector that's continuing to expand at a very rapid pace, even if, let's say 10 years down the line, we look back today and we had overvalued tech. I still think that this is going to be an increasing weighting towards tech over the longer term. This is actually a topic that I covered in detail in a recent video I made, where we spoke about the overall sector weights across the American stock market, and mega cap companies really have a chance here of continuing to dominate for the foreseeable future, as they just have so much capital on hand, as well as they're kind of being seen as a safe haven in the current stock market. So that being said, QQQ is a great option for investors who do want maybe that higher concentration of tech stocks and are willing to take on the higher risk for higher rewards over the long term. This is a fund that's averaged annual returns of 10% per year since inception in 1999, and over the past 10 years has averaged annual returns of 22%. And coming in at growth stock number 4 here, we have ARK's Innovation ETF, ticker symbol ARKK, which I know I might get some heat on this one because performance has been less than stellar for this fund and basically all of ARK's funds over the course of 2021, following the insane euphoria that all of Cathie Wood's funds received from the retail investing community in the first half of 2021, where they reached all-time highs. But just quickly hear me out on this one. I wanted to share my thoughts. RK is an actively managed ETF and happens to be the only one that we're going to be covering in today's video, and with it comes a higher management expense ratio that may or may not be justified depending on your thoughts surrounding this fund's holdings that are concentrated on companies that are considered to be disruptive innovation over the next decade. Basically, every article that's coming out about Cathie Wood's ARK funds is negative and bearish right now, especially around her investment style. And I will concede that ARK ETFs have been among the worst ETFs that you can buy and hold on to over the course of 2021. But there's no denying that right now the market is absolutely in a state of fear, especially regarding companies like these that are considered to be quote unquote pure growth plays. And ARK's investment style is the complete opposite and does not go hand in hand, I should say, with the current market sentiment compared to last February when the market was in a full-on state of euphoria and greed. From an underlying standpoint though, nothing's fundamentally changed from the companies held within this fund like the Teslas, Roku, Coinbase, etc. In fact, they're actually continuing to grow as companies. It's just overall market sentiment and investor sentiment that has changed. With that said, keep in mind this is an ETF that I absolutely think we're going to be continuing to see heavy levels of volatility, and it could very well continue selling off over the next year, maybe longer, considering the current interest rate environment that's supposed to take effect starting this year. But at a share price that's down more than 50% from its all-time highs, this is definitely an ETF that I think is worth keeping an eye on at the very least over the course of this year and beyond. And finally, coming in at number 5, we have the Vanguard Healthcare ETF, ticker symbol VHT, that tracks companies from across the healthcare sector as a whole, including stocks of companies involved in medical or healthcare products, services, technology, or equipment, so really the whole spectrum of healthcare all in one single position. This ETF's expense ratio is also on the lower side at 0.1%, which is quite nice for a sector-specific ETF actually, considering that it's spread out across over 450 companies that specialize in pharmaceuticals, healthcare, and biotechnologies. Now, although the VHT ETF is industry-focused, which as we spoke about earlier, can possibly prove to have higher levels of volatility, well, one single share of this exchange-traded fund is going to provide exposure to hundreds of different companies in the healthcare industry that are poised for further growth over the next decade, as we're only seeing an increasing population, but then also an aging population. So these are companies that are going to continue seeing steady appreciation over the next decade and beyond. In fact, taking a look at VHT's market movement over the past 2 decades, we can see this phenomenon firsthand of slow and steady growth, where despite natural peaks and valleys, it has maintained a long-term growth trend, which again, I believe we'll continue seeing despite natural ebbs and flows of the market along the way. Okay, so 5 growth ETFs out of the way here, and I just want to quickly mention that realistically, the average retail investor could easily just put 80% of all of their funds ready to invest in a broad market equity ETF like VTI or VOO, and the balance just in a broad bond index to smooth out the ride. That's it. Seriously, this video could easily just be over right here. Oh, but hey, an 80-20 split between equities and fixed income might actually not be suitable for your needs as an investor, depending on your age, your time horizon, your risk tolerance, all of these factors coming into play to make your investor profile. So this is where my full stock market investing course comes into play, where I've made a full course with over 60 video lectures going over everything you need to know about navigating the markets, understanding what you're looking at, how to analyze companies, how to analyze different exchange traded funds, all of this so that you have the knowledge to build your own stock market portfolio suitable for your needs as an investor. Make sure to check out the link down below in the description where you can get lifetime access to this course. Oh, and with that said, if you're interested in maybe generating a little bit more cash flow with your ETFs this year, which hopefully is more than this $1 here, well, keep watching because we're now going to be covering 5 income-focused ETFs. Starting with the first income ETF being the Schwab Dividend Equity ETF, ticker SCHD, that has a relatively nice dividend yield considering its low management expense ratio of 0.06%. Think of this as a super hands-off approach to dividend investing with a best of both worlds for capital appreciation, but then also a nice current dividend yield at 2.9%. You see, usually with higher dividend yield ETFs in the 5 to 6% range, you're usually sacrificing any type of capital appreciation, but that's not the case with SCHD. That is return investors on average around 15% per year since the fund's inception, including the dividend income. This is because SCHD holds rock-solid dividend companies like Coca-Cola, Pfizer, as well as PepsiCo, among others. So if you're looking for a really easy income ETF, SCHD could be a great option for capital, but then also dividend growth over time. But what if you're more interested in that dividend income and stability over the capital appreciation? Because we already covered that earlier on in the video with those other equity ETFs. Well, this is where the next ETF comes into play, being the Invesco Preferred Share ETF, ticker symbol PGX. This ETF is totally different than any of the other ones that we're covering in the video because this ETF actually holds preferred company shares instead of ordinary shares. And without getting into the weeds between the difference of a preferred versus ordinary share, typically preferred shares are seen as more of a fixed income instrument, even though they aren't fixed income like bonds, but these also typically come with more consistency with that dividend income, and also it can be slightly higher. However, you are usually forsaking capital appreciation. Essentially, you're giving up more capital appreciation for the dividend income and stability. But the PGX ETF offers a very nice 4.87% dividend yield that's also paid out monthly if that's something you're into, due to its preferred share holdings in American financial companies. And just to quickly show you what I mean by higher dividend stability but no appreciation, here's what PGX looks like over the past 10 years. This truly is a position for that dividend income. Coming in at income ETF number 3, we have the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD. So unlike with a pure S&P 500 ETF that's buying shares of the top 500 companies in America, well, this ETF is focused on the top 50 that have the highest yield relative to a low amount of volatility. So in this case, we can set aside the typical companies from the S&P 500 like the Apples and the Googles here that have a very large weight in exchange for companies that have lower volatility and a higher dividend yield, like for example Chevron, AT&T, and other companies concentrated in utilities, consumer staples, and energy sectors specifically that are characterized by higher dividend distributions, giving SPHD a very nice dividend yield of 3.5%. And of course, as to be expected here, leaving out tech from the S&P 500, well, the overall returns of SPHD are lower than the S&P 500, but considering the higher dividend income, could still be a very nice option for some investors who do want that dividend income, but then also benefit from some capital appreciation over time. And then moving into income ETF number 4 here, we have a real moneymaker with that dividend income, but also the capital appreciation, being the Wisdom Tree US High Dividend Fund, ticker DHS. And other than the company having a really cool name, the DHS ETF is great for investors who maybe want a slightly higher dividend income from an exchange traded fund at a dividend yield right now of 5.09%, which is actually quite high for an ETF that is not utilizing a covered call strategy. This ETF is able to achieve this higher yield though by investing primarily in healthcare, consumer staples, financials, and energy, which also means that this fund has been seeing some nice appreciation over the past couple of months, which should definitely continue over a long-term hold. Hey, I also want to quickly mention here that when it comes to a dividend ETF, it's really important to also look at the overall cumulative returns of the fund, being the appreciation combined with the dividend income. Because, for example, if we take a look at the SDIV ETF, sure, the yield is really high at 12%, but you're massively forsaking capital growth, where cumulative returns often end up being flat in the bigger picture. And that's what's called a dividend trap, which a lot of newer investors fall victim to if they didn't make it this far in the video, which thankfully you did. So I hope this video gave you some great starting points for passive ETFs this year. If you did, you know what to do. Make sure to smash the like button. And if you want to start investing in some of these ETFs or other individual stocks, make sure to check out the first link down in the description where you can get 5 free stocks valued up to $7,000 each if you're American using Moomoo. And if you're Canadian, there's a link down below for Wealthsimple Trade, where if you open up an account right now, there's an exclusive promo with my code where you can get 3 free stocks, each valued up to $4,500. So thanks for watching today's video. You're awesome, and I'll see you in the next one.